Namaste and welcome to VD Decode YouTube channel.
The most destructive financial mistake is using one product to both protect your family and grow your wealth at the same time. The financial industry actively blurs these lines to sell hybrid policies. This intentional confusion leaves people dangerously underinsured, usually because they fall for a few pervasive myths. First, people assume policies only pay out when someone passes away, or that coverage is entirely off the table once you hit a certain age limit. This document highlights the core rule: always separate insurance from investment products. Yet, young professionals consistently ignore this. They assume their health makes them invincible, or that the basic group coverage provided by their employer is a sufficient safety net. In reality, your 20s are the exact window to lock in a massive safety net. Getting pure term insurance early guarantees you coverage before lifestyle inflation and higher expenses take over. By paying a very small annual premium right now, you secure full coverage for decades and entirely bypass the strict medical underwriting that causes older applicants to get denied. True financial security requires treating insurance as a strict, necessary cost to guard against catastrophic risk, completely divorced from your wealth generation strategy. If you have dependents, the industry standard is straightforward. You need an insurance coverage amount equal to roughly 20 times your annual income. Whole life insurance is designed to sound incredibly appealing for this exact goal. It promises coverage that stretches all the way to age 99, along with a guaranteed financial payout. Look at the math here. Securing 2 crore coverage through whole life requires 70,000 rupees annually. That exact coverage in pure term costs just 15,000. Because of this extreme cost, whole life is only recommended for specific estate planning. Pure term insurance provides the massive coverage you actually need. The catch is emotional. You must maintain the discipline to pay the premium, knowing you get zero financial return if you survive the term. Prioritizing maximum coverage through a term plan over guaranteed payouts is the only mathematically sound way to protect your dependents without bankrupting your lifestyle. Then there are the products that promise the best of both worlds: UILIPs, moneybacks, and endowment plans that blend life insurance with market returns. This chart illustrates the mechanical flaw of a UILIP. Your premium is immediately hit with fees, cannibalizing your capital before it enters the market. Over 20 years, this initial fee drag compounds. A pure SIP scales exponentially, while the UILIP's growth is severely diminished. Money-back plans suffer from a different flaw. They offer structured payouts every few years, but the internal rate of return barely outpaces basic inflation. Endowment and pension plans combine life cover and retirement savings, but the result is a policy offering dangerously inadequate coverage relative to the heavy premiums you pay. Separate the two goals completely. Route the premium difference into an independent mutual fund. When you retire, execute a systematic withdrawal plan. Hybrid policies guarantee mediocre returns and poor coverage. Separating your term insurance and SIP investments ensures maximum protection and optimal scaling of your wealth. All of that optimized investing means nothing if a single massive medical emergency strikes. Hidden traps in health insurance policies can wipe out years of wealth accumulation. The most immediate danger is a copayment clause. Accepting a cheaper premium forces you to pay a fixed percentage of every single hospital bill. The math on copays is catastrophic. Saving 3,000 rupees upfront can cost you 1 lakh on a 5 lakh bill. Furthermore, room rent limits apply a cascading multiplier to all other treatments, triggering massive out-of-pocket charges for premium hospital care. To expand your safety net without buying a massively expensive high-limit base policy, the most cost-effective tool is a super top-up. A super top-up seamlessly activates after your base policy's financial limit is entirely exhausted. It provides a massive extra layer of coverage for a fraction of the cost. From there, you strategically add a critical illness rider. This pays out a vital lump sum upon diagnosis, covering non-hospitalization expenses and lost income. True health security isn't about buying the most expensive policy. It comes from stripping out restrictive clauses and layering strategic top-ups over a solid foundation. The non-negotiable rule of personal finance is clear. Insurance is a shield meant to protect your capital. It is never the engine meant to generate it. Looking at this matrix, a young family's blueprint is straightforward. Secure a pure term policy at 20 times your income, a zero copay floater, and super top-up. For wealth builders, you aggressively decline ULIPs, redirecting that premium difference entirely into market SIPs. And if you are in a high-risk occupation, you stack a standard term plan with accidental death and waiver of premium riders, ensuring a sudden disability doesn't cancel your family's protection. The best financial products are often the most boring ones. They sit quietly in the background, designed solely to deploy capital during a worst-case scenario. Mastering insurance is not about trying to get a return on your premium. It is about buying the absolute freedom and peace of mind you need to aggressively build real wealth everywhere else in your life.